Welcome, guys, to the Trader's Desk. It's the 23rd of March 2025. This is the last webinar that we'll have in this series. Before we get started, as always, this is not financial advice. This is purely for educational basis. Do read the disclaimer. Also, all the content here is owned and copyrighted by the Financial Traders Hub, so do read this copyright notice. So we'll go right away into some charts. We'll also spend quite a bit of time in Koifin, just looking at what's been happening in the market. Let's start off with the S&P 500, right? So this has been quite an interesting week. If you've been following markets, it would feel like a lot of activity has happened during the week, but then if you look at it, we've basically ended exactly where we were last week. So a lot of moving around, and then eventually we settle flat or relatively at the same level as last week. So that's quite interesting because we're sitting right at the 200-day moving average. And that's a critical technical juncture in that if the S&P 500 is not able to rally above this 200-day moving average, this could be a little bit, it could invite a bit of selling pressure. And it's also indicative that, the market is not able to rally further, which would be indicative of a lot of, whether it's stress or whether it's down to GDP slowdown. It's definitely telling you that the market is going to go much lower from here onwards. So I know we've had a lot of discussions in the Discord server, predominantly between myself, Darren, and a few others, Bhavan as well, trying to ask the question as to, are we hitting a bottom here? Is it time to start buying? Or are we going to go much lower? If I look at this week's trading action, I would certainly not say that we've hit a bottom. If you can see here, the S&P 500 tried to rally, got denied, and then basically you have got more sellers that come in and keep selling stocks into the rally. So it's not yet clear that we've reached a bottom, even though we've had a little bit of moderation in the VIX index. So this has definitely pulled back a lot from the highs of 29 last week. So we are at 19. It's not too low, not too high either. It's still well within the range of what the VIX trades normally. And keep in mind that this can change on a dime. This can go back to 30. This can go back to 15. So this is a gauge of volatility. It's not something that we can predict accurately, but we do look at it just to get a sense of what's the mindset of market participants. As we know, as volatility goes up, so funds tend to deleverage, which means that they will be selling a lot of their holdings. And when this goes down, then funds become more in a portfolio management uh, kind of mindset, whereby they start building positions with time horizons of 3 to 6 to 12 months ahead. So that's something we need to be very careful about, because the longer the time horizon that people are able to assign to the market or to individual stocks, the more benefit of doubt they will give to stocks that have poor near-term fundamentals. I think we've seen this a lot, right? Like there's been a lot of back and forth, right? With a lot of companies like CarMax, BC, a lot of these cyclicals, right? Where we know there's going to be pain, but then the market somehow gives them benefit of doubt. They rally like 10, 15, 20%. And then the market regime changes back again and they sell off again. So um, eventually, if you look at these stocks, they're basically trading in a range. Like if I look at CarMax, right, it's basically been trading in a range from 2022 all the way till now. Now it's broken below this this trend line support. So this is a very interesting situation. Is this going to go much lower? Uh, there is a case for this to go much lower with delinquencies creeping up in the auto sector. We know that CarMax is selling a lot of cars, but it's also financing a lot of these cars itself. So it's putting this on its own balance sheet. And a lot of the losses that will come from auto delinquencies will feed through the P&L of CarMax. So this will ultimately affect the earnings power of CarMax. So if this gets worse from here, I wouldn't be surprised to see CarMax go back to the low 60s and 50s. Um, Although fundamentally, when I look at the situation, I think the worst is probably over for CarMax. Used car prices have stabilized and maybe are starting to rise also. So they're able to make a little bit of margin or improve margins based on selling of these cars. But now the question is whether auto delinquencies will get really bad and bad enough to, make investors really scared in this situation. Uh, I don't have the answer to that. I thought that if CarMax would be able to hold this level, maybe, it would bounce off and this could be a good long opportunity to have. At the moment, I'd probably steer clear of this and just monitor the situation with respect to auto delinquencies. I think there are also better ways to play auto delinquencies than CarMax. There's Ali, there's a few other stocks that you could also look into. But certainly these are the regular ones that we want to keep track of and make sure that we understand what's going on in these stocks. So going back to the whole picture of the VIX and the mindset of the market in terms of how much of a long time horizon they want to assign to their view at the moment. It's also with respect to the number of uncertainties that they see ahead of them. So there are two types of uncertainties, right? One is the uncertainties that the market can quantify. So, for instance, if there's clear visibility into the future and we know that GDP will fall by, let's say it will fall to 0.5%, right? The market can price that in. What the market cannot price in is the back and forth, let's say Trump tweeting, okay, I'm going to put tariffs of X%, then tomorrow it's Y%. That's not something that the market can quantify. And this is the type of, because a lot of times people say that the market doesn't like uncertainty. But that's not true, right? Every situation you get into has uncertainties. What the market doesn't like is situations where it cannot quantify the uncertainty, right? So even if you go into, let's say, COVID-19 global financial crisis, the market is still trading. It's still being able to place the value on risk, and stocks trade accordingly. What the market is not, it doesn't like and is not able to do properly is to predict what's in the mind of one individual and how this will go depending on, let's say, his mood on the day or something that's very, very subjective. So that's what the market doesn't like. And in these situations, the market will prefer to not deploy capital and stay in cash, especially if, at the moment they're getting paid quite handsomely in terms of interest rates by sitting in cash. So they get paid to wait to get more clarity on the future and reduce the type of uncertainties that they don't like, which is the unquantifiable bit, right? Does that make sense? Is that making sense? Just give me a quick check
Yes,
on your end.
yes.
Yep. So this is the way to be thinking about the markets, right? As the future become clearer, you'll see that even if it's a bleak outlook, there will be a lot more participation in the market in terms of trading volumes, in terms of liquidity, um, because the market is getting closer to a point where they can put a value on the risk, right? And I think so. Trump said that the tariffs were kicking on the 2nd of April. We're yet to see exactly what that would be. We don't know if he's going to change his mind at the end and change the number in terms of what tariffs he was going to implement. We also don't know a lot of the discussions happening behind closed doors, whether that's tariff related, whether that's trade related, whether that's related to the war between Ukraine and Russia, anything happening in Israel and Palestine. So a lot of this, the market cannot quantify it, and it would rather sit on the sidelines, get more visibility, and then start deploying capital one way or the other. So we have to be mindful of this because I think a lot of you would have seen that the market has been trading at relatively low trading volumes, and probably you're scratching your head and trying to understand what's going on. Why is the market not trading usual volumes as it used to? That's one of the reasons. Because people just move into cash and they've already moved into cash and they're getting paid quite handsomely to wait and get more visibility. So that's a little bit in terms of how you frame your mind around what's actually happening in the market. It's difficult because there's not just one market participant and everyone is not just doing one thing. The end result of the collective action of all the market participants is basically what you see on these charts, right? Let's move on to the Nasdaq. So this is a little bit more interesting because the Nasdaq, uh, to me, this is a sign of a technical failure. Uh, I don't think I need more confirmation. From my perspective, this is a technical failure. So the Nasdaq moved from the highs all the way down. It kind of bounced off the 200-day moving average. This week was okay, so it held up. The next week, it opened below the 200-day moving average, moved a lot lower, then managed to claw back a lot of the losses, but still closed below the 200-day moving average. This week, same story, tried to rally above the 200-day moving average, barely survived, and then got sold off again, right? So again, it's very similar to the S&P 500 where it closed at relatively the same level as what we had seen last week. So a lot of moves, right? Daily moves, but on a weekly basis, not really much has changed. And this is something you have to keep in mind because a large part of this sell-off is being driven by the Nasdaq, predominantly by the Magnificent Seven stocks, right? So if that's the technical picture for Nasdaq, and if we move to the Magnificent Seven, again, this is the technical picture. So one could argue that these guys have clawed back their way and managed to hold up the 200-day moving average. So we need maybe 1 or 2 weeks of confirmation to see whether this is heading higher or heading lower or going sideways. Um, what I'm seeing here is at the moment, there are no clear signs that we've bottomed. I think that's the point I'm trying to make. Even if we see VIX headed lower on a technical perspective, we're not seeing signs that the market has rallied with significant trading volumes and that the way is up from here. Okay. I'll encourage you to ask any questions based on what I've discussed so far. Feel free to unmute and get involved too. Do we have any questions?
Yeah, I might have one question, Roshan.
Go for it.
Uh, the VIX index going up and down,
Mm-hmm.
and the fund managers' positions changing based on that. Like, which comes first? Like, the VIX index goes up when the selling is high, or when VIX goes up, the selling goes higher?
So
Which one?
it's a good question. It's basically like the good guys in the market would realize that VIX will go higher and they will sell in anticipation of that. And then as the larger funds sell, it increases volatility in the market, which basically increases VIX, right? And then as this is going higher, then the remaining funds have to start deleveraging, which increases the sell-off. Does that make sense?
Yes.
So let me give you some perspective. So you would remember in January, as we were doing these webinars, I was looking at the Magnificent Seven. It had not yet broken, right? It was basically, let's just take a quick look. So it was basically probably here. No, actually in January. So I think this is when we started either this candle or this one. Not sure when, but this is probably where we started looking at Magnificent Seven, right? Um, and we had already started saying that look out for weakness in this stock, in this ETF, because if this weakens, then it's just going to cause a flurry of selling, right? Um, so what do you think we would have started doing as we see that, this is weakening, and then we have another week uh, where it basically just goes much lower. So we start putting short positions here, right? In anticipation of what could unfold. As we get further into this, this is a big technical sell-off. As it breaks this support line, you're probably going to be selling more, also buying more puts. And then you sit tight and you just ride this whole wave here, right? So if we were to plot VIX against this, you'll see that we've started looking at it here, right? Uh, VIX was probably, so let me just change the scale. So VIX was maybe in the, yeah, so VIX was around, let's say 17, 18, right? So, well, no, actually here, right? So VIX was around 16, 17, 18. Yeah. So 18, 16, 17. Not really much of a worry for the fund management space. So they start getting a little bit more worried when it gets above, let's say 15, 17, 20. 20 is basically like something that would get them to become scared, right? So we start looking at this maybe in the mid 15, 16, 17, and we started putting short positions somewhere here, right? So as an example, alternation and all of this, I started getting short probably, I don't know, mid of Jan. So when VIX was relatively low. And then as the sell off happens, you can see, right? This is the moment when everyone is just heading for the exit door. And this is when VIX will also creep up. Is that clear? Does that make sense, Bhavan?
Yes, yes, yes. Sorry.
Okay. So if you look here on this big technical breakdown, the VIX was still around, let's say 18, 19. And then it's on the next candle that it just gets crazy, right? So what you also don't see here in this VIX chart, because it's a line, you don't see the range of the movements. Um, I'm just going to see if I can change this. I don't think I can change this here. No, I can't do this. But if I were to just plot VIX, right, you'd see that on days where on the line it's showing up as 19, it's also gone up to quite a bit, right? So it's fluctuating a lot. And it's this fluctuation, that it's this wild range of the VIX that, the market gets really scared of. Because, I mean, look at this one, right? We go all the way to 65. And that's basically panic mode. It's just, everyone just starts panicking and selling. Um, yeah, so moving on, what I also wanted to show you When we look at the small cap index, so this is the IWM. So sometimes I use index and ETF interchangeably. For my purposes, it doesn't really matter because I'm just using it as a proxy to understand what a basket of stocks are doing, right? So the technical term is ETF, but sometimes I will use index. Um, so you're asking, does it not look like the VIX is starting to move lower now? Yeah, that's a good point. That's a good point. So um, this is where if I had seen maybe on a technical level that the market is holding up and the VIX is also coming down, I would have a lot more conviction in saying that the market has bottomed, right? So at the moment, I'm not seeing this. And I'll also go through a lot more in terms of what forms my view to kind of drill down to the point. And of course, I can be wrong. I can be wrong for a couple of weeks. And then in the third week, you see a big sell off, you see the resumption of the sell off. Markets don't move in a straight line. Even like the biggest of sell offs have what we call bear rallies, and they can go on for a couple of weeks, couple of months. So at the moment, I don't know what the future holds, right? But I can certainly form a view. And then as more information comes that proves or disproves my view, I will be changing and altering course accordingly. Does that make sense?
Yes, thanks, Roshan.
Because see the where people get stuck is that they think that if I put a view out or if this is my stand, then I have to draw a line in the sand and basically die on my sword, which is never the case here, right? We're always looking at things from a very probabilistic manner. We know very well that we cannot predict with 100% certainty. And what's required is basically a process to form the view and then be on the lookout for incoming information, whether that's in terms of price action, fundamental information, anything that's happening on the regulatory front, um, you know, also price action overseas outside of the US. Take all of that in and then figure out what your updated view should be. So you're always trying to get closer to the truth, knowing very well that you will not be able to have 100% accuracy. Um, Looking at the small cap ETF, the IWM, this is the reason I'm looking at this is because this is isolated totally from the big seven companies in the S&P 500. This is these are smaller companies that do business predominantly in the US, so their revenues will be more US centric. Okay, and by virtue of this, um, we'll have a better understanding of what investors are seeing or how investors are um, what's the outlook in terms of the US economy itself, right? And also keep in mind that these smaller companies tend to have riskier balance sheets, so they will tend to have a bit more debt. They will tend to be a little bit more cyclical than what one would like because they tend to be a bit more niche down. They would also tend to have lower quality management. So um, all of this gets factored in, and whenever there's a risk off scenario, investors will understand that they are dealing with managements which are probably not the best, companies with not the best capital structures, companies that won't have a lot of cushion if there was like trouble in the economy. So a lot of this gets priced in accordingly, and that's why you see maybe that some of these stocks would have far higher volatility than your large cap stocks. So what we're seeing here in the IWM is a clear technical breakdown, right? The 200-day moving average has broken down. The question we have to ask ourselves is We've seen a similar price action on the S&P 500 and the Nasdaq 100. Uh, what we see on the Nasdaq, right? Is this going to become similar to what the IWM is, whereby this sells off even more, and then we have confirmation that we are much closer to a bear market as opposed to a bull market. So I'm just going to draw something. I just want to show you from the peak, so which would probably be here, all the way to the bottom. So the IWM has sold off by roughly 17% now. That's a lot more than what the S&P 500 and Nasdaq have sold off by. And of course, that's because of what I've just mentioned, right? So S&P 500 probably has sold off, let's say, 8-9% from the peak. Nasdaq a bit more. So yeah, 11%. And the IWM is kind of leading the way, right? So the question is the IWM one step ahead and just leading the way for all these larger caps? And the direction is in fact, or the trend is in fact down. And we're probably not going to see, a resumption to the bull market price action anytime soon? Or is this going to be a different story altogether? At the moment, we don't know, but I'm leaning towards saying that the sell-off is not over. Maybe we'll get a bit of a bounce here and there for a couple of weeks, but I can certainly see how the market can go much lower from here onwards. Um, Also, what happens is a lot of these bottom pickers. So it, I think it helps to just put this on a daily chart, right? So this is the S&P 500. I'm just gonna make it bigger. So if you look at this, it's a series of daily lows, uh, lower highs, lower lows, right? It just keeps grinding lower. And then eventually people think that maybe we've reached the bottom. So you get a lot of bottom pickers. A lot of the shorts are also covering, taking profits. Then the bottom pickers take the stock much higher. People think that, yeah, now they have to buy the dip and participate. But look what happens. The next day, they just get denied. So a lot of them get shaken off the tree. They make the price action even more bearish. The next day, they attempt to make a new low. They all get denied around this area here, right? So the market is not able to go higher than this level. And eventually, on Friday, it just opens lower. And then towards the last hour of the trading, it kind of grinds up. So probably not last hour, maybe last half session rather. So it was quite bearish during the day, and then it kind of clawed back its way, but nowhere near these highs over here. So when you look at this and you combine this with the relatively low trading volumes, you can see that the smart capital is actually not participating. They're probably in selling mode or distribution mode, and this is basically being driven by short covering and a few bottom pickers. And I'm sure even in the institutional world, right, you'd have a lot of people who are trying to buy the S&P 500 and make a buck here and there. But overall, what we see is as a collective, as a collection of market participants, we're not seeing significant participation that would actually drive the market higher. What I'm saying is that the selling is not over. There's a lot more sellers than people think. And it's typical of a deleveraging situation. So if you think about it, funds came into 2025 very bullish with a lot of leverage. Volatility was relatively low. And also at the same time, you have the whole prospect of this, Japanese yen carry trade unwind. All of this is happening at the same time. And a lot of these guys who are involved or trapped or caught in this whole mess, they're not in the mood of buying stocks. They are mostly sellers, right? They're getting a lot of selling. They're getting a lot of redemptions. They have to sell and raise capital to be able to pay back the investors. So that's actually what's happening behind the scenes. Even if the financial media reports S&P has the first high in the last 5, 7 days or whatever, it doesn't really matter. When you look at what's happening with the price action, it's quite evident. Like this is the USD Japanese yen. Um, you're not gonna tell me that this has bottomed, right? It's technically broken. It's heading lower. I think it will try to test the lows and it could even go much lower. So the something I wanted to show you is this. The Japanese CPI core index. So the whole reason for the yen carry trade unwind is because the Bank of Japan is worried about inflation and they are hiking in response to inflation, right? So that's the reason we're looking at the core inflation metrics in the country. And what you can see here is this is just going higher. What's even worse, I don't think we have it here, but the wage inflation is going higher in Japan. I don't think we have it in this index. Maybe I'll need to look at something else. Okay, it's probably under labor wages. Um, yeah, they don't. Okay, maybe I should do this. No, cannot do year over year. I think I could do this, right? This one is probably. Yeah, maybe you can use this as a proxy. Um, there is an official number. It's not actually this, but let's use this as a proxy, right? Look at the wage inflation. It's uh, it's at a multi-year high, right? I'm looking at the 10-year chart here. Now it's looking like it's heading lower, but it's still, 2.8%. When you look at the core index, which is roughly, what was it, 2.2 something? Let's go one back. Yeah. So 2.6, right? The reason why we look at wage inflation is because it paves the way to long-term inflation. So think about it. Whenever you've gotten a raise at work, the next year it tends to go higher. It I mean if it goes lower, you should probably say no and move out of that job. But typically wages keep going higher, right? And the higher the wages go, the rental index, prices of goods and services will also move in line over the long term. So that's why the BOJ is quite sensitive and quite worried about the inflation metrics in the country, and they're also hiking in response to that. So when they hike, the Japanese yen will get stronger. People would want to buy more Japanese yen because you get a higher interest rate rather. Um, and then when you contrast this with what's happening with monetary policy in the US, we're talking about cuts. From here onwards, we'll be cutting, at some point. So that interest rate differential between the US and Japan would actually cause the USD to weaken with respect to the Japanese yen. So there is a lot of room for this to move much lower. And for all the people who've been borrowing cheaply in yen, investing that in the US, predominantly in US tech, there's no way out, right? So the smart ones have figured it out and they've already created, this big sell-off that you've seen. Um, but I'm pretty sure it's not over. There's a lot more to come. And the only question here is whether this will be significant sell-off like we saw in July and August of last year, or whether this will just be a controlled sell-off over a prolonged time period. I don't have the answers to this, but I can only share what I think is happening behind the scenes and give you all the metrics to look out for. And if this goes much lower, you should know that what I'm discussing will get a lot more amplified. If somehow inflation gets back into control, then hopefully, let's say, crisis might be averted. So that's basically how I look at things, how I build my process around these things, because all the information we're looking at will keep changing in the future, and we have to adapt our view accordingly. So you need a lot of flexibility in the way you look at things. Um, you should not be dogmatic in your thinking, saying that this has to happen, and you won't rest until it happens, and you'll try to find all types of confirmation bias just to justify to yourself that this is actually going to happen. When things change in terms of the data, you also have to change your views accordingly. So that flexibility is required, and the way to be objective about these things is to understand what your view or views are constructed on, and then as the pillars of that view is getting stronger or weaker, you have to adapt your view and change your views accordingly. Is that clear to everyone?
Yes, thanks, Roshan.
Super. So that's the main indices so far. Let's maybe look at one more, the RSP. So this is the equal weighted version of the S&P 500, right?
Roshan, can I ask you one question before you
Yeah,
move on
go
to the
for it.
next topic?
Go for it.
So your view on the continued sell-off will keep on going is based on the Japan, uh, USD Japan carry trade, right?
Yeah,
How
so
about you?
so that would be mostly in the tech sector.
Tech sector,
Yeah.
yes. Yeah, my question is like exactly that. So how
Hmm.
about US growth slowdown? Do you have a view there that will contribute to the sell-off?
Yeah, so look, from my perspective, it seems that all these factors are just converging together, and it will just make life hell for a lot of people in the financial markets. So from the Fed meeting this week, there was only two or three things I took away, uh, and it's probably not being covered a lot. A lot of people are talking about QT and all of this, and that the Fed is planning for two cuts, and all of this is always already known by the market. Powell himself said that he was discussing reducing the pace at which the Fed is gonna reduce their balance sheets, right? That was already known by the market. It's not news. What was quite telling was that the Fed themselves downgraded the expectations for GDP growth. So that came from, I think, 2.1 to 1.7 for the year. Um, for the year, for the quarter, I should just double check this. Let me just get a quick view of this. Let's go through this as we are discussing this topic. It's very important, so I don't want to miss any detail. So let's not do that. Yeah, this is what I'm referring to. So if you look here for 2025, right? So this is basically for the year. They've downgraded their change in real GDP from 2.1, which was the December projection, to 1.7. So this is an admission from the Fed that the economy is slowing down, right? Even if Powell says the economy is doing well and all of this. On paper, officially, this is actually what we've seen. And then going forward, somehow GDP will hold up to 1.8 and 1.8%. So we all know that GDP is cyclical. I've never seen a flat graph of GDP growth. It either goes up or it goes down, right? I've never seen a graph of GDP that's basically just flatlining. For them to have 1.8 in the next 2 years and longer run 1.8, I don't know what this means, right? I've never seen this before. And basically, if GDP growth is on the decline, I would expect it to keep going lower, right? Until it forms a bottom and it comes back up. So that was one key thing to note. The other one was the PCE inflation. We could look at both of them. So if we look at core PCE inflation, in December, they projected 2.5% per annum. They've revised that upwards to 2.8. So even if Powell says he doesn't really give much weight to whatever the consumer expectations of inflation has been in the last 2 months for the surveys, uh, I think that's not true. I think as a collection of individuals, these members are paying close attention to these metrics, and they are upgrading the expectations of inflation as at the same time. So you have to remember, very few people will read these reports. Everyone will tune in to listen to Powell, and he's talking to the masses whenever he's talking. He's doing his live conferences. Um, he knows very well that these documents are official, and this is basically what the whole team will be judged or held by. And things get done properly in this document. But when it comes to the speech, he can always introduce his own subjective judgment, right? Remember, he's talking to the masses. He's not talking to financial participants only. So these were two notable things. And also, one more thing. They increased the unemployment rate expectation to 4.4. Not significant, but you have to keep that in mind. And then you can look at this chart. It's a bit easier to understand the range of what they expect GDP growth to vary by. And same for PCE and so on, right? Um, I also posted a comparison of this dot plot versus what we had in December. So that was also quite interesting to see what the collective individuals are saying. One thing that was quite interesting was that uh, I think it's in the other report. I wanted to show you this. So this is basically the committee, right? There was one guy, this guy, he was a dissident. So uh he voted against the this particular action, which was basically, so he wants to keep federal fund rates unchanged. And but he preferred to continue the pace of decline of the asset base of the Fed. So he's got a different view from the rest of the group, and it's very rare that we have dissidents, especially under Powell. It's I've only seen it happen a few times, but it happens mainly when there is uncertainty about the future, right? So people are looking at things differently, and all these committee members, they also speak to their own business, the businesses in their states, and all the participants and so on. So everyone has their own individual views, and they have their own estimates, and by virtue of that, they either agree or disagree with the action that the Federal Reserve is putting on the table. So this is interesting because I have a feeling that in future we'll have a lot more dissidents, especially as the economic picture gets a bit murkier. So watch out for these things. It's quite indicative, and it doesn't come across a lot in the financial media because, as usual, people don't talk about things that don't excite the masses. But what excites the masses doesn't move capital markets, right? So keep all of this in mind whenever you're thinking about what the Fed might do. They've said they would probably do two cuts this year. The market already expected this, so it was unchanged. If you look at the Fed funds rate, the expectations for December, it barely moved on the day that the Fed was speaking. So that tells me that all of this was already expected. So let's move on to the RSP, the equal weighted version of the S&P 500. What we can see here again, we're seeing a little bit of a technical failure. It's not yet confirmed. It tried to rally higher, but did not manage to do that. So the sell-off that we're seeing now is not just limited to the big seven or big 10 in the S&P 500. It's going across the board, and that's to do with the economic slowdown. So this is something that we have to keep in mind, especially as we think about the next few months in terms of how we'll be positioned in the market. Next week, we could be certainly trading much lower here. And, this will be a confirmation of the technical breakdown. We could also move sideways and, it just becomes a little bit more frustrating where you have to wait until you get a sense of the direction, whether it's up or down. But that's in a nutshell what's kind of informing my view in terms of saying that the sell-off is not yet over. So I'd invite you to ask any questions. Maybe share your own views with me, how you interpret these things. Go for it. Don't be shy. We don't have any views.
Yeah, I think I was just saying, I guess I was looking at the RSP as well at my
Mhm.
end, and I was looking at the daily chart, Roshan.
I've got the daily one here.
And then yeah, and then like once I turn that on and I have the 200-day moving average on, it looks like it's rejecting
Yep.
it as well.
Let me just replicate that. I normally use weekly, so I just have to
Hmm.
adjust this accordingly. It would have been great to have this function, right? Where
Yeah,
they do
indeed.
it automatically. So this is the 200-day moving average here, right? You can see,
Yeah,
right? It's very clear that there's a clear rejection at this 200-day moving average line. Yeah. So
yeah.
would you be surprised to see that this week actually confirms on a weekly basis that you know there's a technical breakdown? I wouldn't be surprised. So
Yep,
these are
agreed.
these are all the things that you need to watch out for because it's very telling, right? I know we don't use technical analysis to put to find stocks, right? That's not the purpose of technical analysis, but technical analysis is telling you how market participants are thinking about the setup at the moment, right? So it's giving you an understanding of whether you should be net long, net short, or neutral in your portfolio. And if you want to be long, which areas of the market is being supportive technically? If you want to be short, which areas of the market are supported technically from that perspective? Is that clear? Got one question. Let's just quickly look at this. Um, change this to 1 day from chart. Okay. So, okay. So you're giving me a tip here. Let's try this. Been looking for this for quite some time. Let's just go back to, if I put it to 52 and then I do, so I think you've solved my problem.
Yeah, I think if you put 52, you need to put week.
Yeah, you're right. That's beautiful. Amazing. Thanks a lot. Thanks a lot. I've been looking for this for a long time. I've been Googling and trying to to figure this out. Okay, super. That's amazing. Thank you so much, Bhavan. I'll do this on my other indicators too. So now if I move back to this, it stays the same. Okay. So now you're a power user of TradingView. Thanks, Bhavan. That's very helpful. Um, Yeah, so moving back to the RSP, which sometimes we can also look at a measure as a measure of breadth, right? Breadth meaning is only a small section of the market rallying or falling, or is it happening across the board? At the moment, we are seeing that this is happening across the board, and it's the sell-off is widening and not just happening at the top of the market. Does that make sense? Before I move on, do we have any questions? Hans, do you have any questions?
No, so far it all makes sense.
So, this is a little bit of what you'll all have to do on a daily basis, as and when you're trying to establish where we're going from here, right? So,
Yeah.
a lot of times when I'm writing in the Discord server, I'm trying to, show you these factors in real time. And you would have seen that so far it's kind of worked out, right? And not to say that, again, it's not like I have a crystal ball hands, right? It's basically like looking at, if you look at the price action, a lot of times you should ask yourself, what is the psychology of this audience here, right? Is this an audience that is just sitting and waiting to buy? They're going to pounce on every opportunity. Like, let's say when we looked at Pinterest, for instance, right? When we got in, it was quite timid, right? No one was really looking at the stock. And then a few weeks before earnings, it really starts rallying. So that's a that's indicative that the psychology in this audience or in this part of the market is that they're anticipating a very good earnings and they're positioning for it, right? So if the stock has a bad day, it would probably go back up. So people are stepping in and buying the stock. If the stock has a strong day, the next day it opens much higher. So people are still willing to buy it higher. This is basically what you're always trying to gauge as you're looking at price action. So I'll show you one stock, Roblox. Uh, we've been having quite a bad market environment, right? Let's move on a daily basis. So S&P is in sell-off, QQQ in sell-off, but look at Roblox. It kind of bottomed here, and then from here, people are stepping in to buy it. It's making new highs, right? So in a sea of red, Roblox is basically making new highs. What does this tell you? People are doing their work and they see Roblox as a good long from here onwards. Does that make sense? This is the concept of relative strength. And the same applies with relative weakness as well. Does that make sense, guys?
Yes.
So if you
Yes.
were looking, let's say you were researching Roblox or you had already done your thesis, but you're just not sure, right? Like this is this is where the market is at. And you're like, I don't know if this is the bottom or not, so I'd rather just wait because What if I start buying here and then it goes all the way down to 45, right? I might just wait for a couple of weeks to see where this goes next. Then you probably look at this and you're like, okay, this is holding up. And then it's making a new high. So I'd probably start buying somewhere here. And of course, you look at everything in line with your time frame, with earnings and everything else, right? So I'd probably start buying somewhere here. And when you see this confirmation here, it's basically other people agreeing with you and wanting to buy it higher. So this could go much higher from here. It could go back to, let's say, 67, 70 onwards. It could also just, maybe trade sideways around 65, waiting for earnings, and then you'll get a better sense of direction. But the whole point here is to make sure you understand what technical analysis is really and how to use it to your advantage to time your positions. Technical analysis is not to form a view on a company, right? For that, you need to do your fundamental analysis, get all the numbers, form the picture about the company, its industry, and then come to technical analysis to establish whether now is a good time to put the position on or not. Okay, so I'm gonna move to some individual sectors now. So this is the retail ETF, right? You can see, right? It's not the best of charts with this whole consumer sentiment getting downgraded. This is probably the first area of the market that got hit. Yeah. So these would typically consist of retailers like uh, Ross Stores, Burlington, TJX, Walmart, and all of these companies. So again, right, you would have thought this has formed a bottom here, but this doesn't look like a bottom to me. This just looks like this sideways action, and eventually it will go much lower. So let's say you have a company in retail where you're bearish. What you should really be doing is use these bear rallies to establish your position for when this ETF goes much lower, which it will inevitably go. That's one. The other one I wanted to show you was the semiconductor index or ETF. So let's look at this on a weekly basis. This has been trending up for a long time. It's hit this support line a few times, but then bounced back quite easily. This time is proving to be a lot more difficult, right? It's broken the 200-day moving average. It's playing with this trend line support. My view is this is a critical situation. So if this breaks lower, that's going to be a lot of sell-off, right? There are many companies that would sell off as a result of this. Your Nvidia, all these IT companies, Micron, Intel, a lot of the companies in the value chain, the companies that help them with designing the software, with, chemicals that are used in the semiconductor processes. There's a lot of components that also get built with autos and all the electronic stuff. So if this breaks lower, you have to watch out and be very careful here, because a lot of times the semiconductors have led the sell-off in the major market indices. If this goes much lower, the S&P, especially Nasdaq 100, would follow suit very quickly. So these are all the factors that I'm taking into consideration as I'm constructing my view on whether the market has bottomed or not, right? And if you see here, right, uh, the trading volumes on the rallies are not the highest. So this is a weekly chart. It's not the highest, right? If you look at this rally over here, Look at the participation, very high volumes, and then it just keeps going higher and it makes new highs. If you look at the participation on this rally, right, this is very timid. There's barely any volume here. So this is more indicative that maybe you've got a bit of short covering, profit taking, uh, bottom pickers coming, but it's not people who are buying on fundamental reasons. Any questions so far? Okay, none so far. It's good. Looks like I'm doing a good job of explaining these very complicated matters to you. Eh?
I have one question there, Roshan.
Go for it.
Um, like we talked about AI team in the beginning of the year, and I think that is still going strong.
Yeah,
So how that's gonna do we need to isolate that when we look at semiconductor and
you should. Yeah, you should predominantly if you're looking at anything that's semiconductor related. So the AI theme spans broadly around hardware, equipment, power, cooling solutions, but also AI software, right? Um, the ones that would be highly sensitive to semiconductors would be the hardware. I think power and cooling are still required as you're building out data centers. So you have to be mindful of that. But also remember, semiconductors is not just AI, right? Um, I'll make a parallel here. You remember when we looked at Lumentum Holdings, they had two broad segments. One was data centers, the other was telecommunications, I think telecom providers. One was extremely solid, the data centers, hyperscalers, and so on. But the telecommunications segment was weak, right? So semiconductors is the same. It's not just AI, right? It's of course been driven by AI with Nvidia and so on, but there's a lot more that happens under the hood. There's, anything from hard disk manufacturing, memory chips for PCs, memory chips for servers, memory chips for phones, devices, you know, all your all your electronic appliances, um, your auto manufacturing, all of this is kind of being bundled into the semiconductor production. What you can also look at for semiconductor, I'm not remembering exactly what the ticker is, but you can look at, uh, we could probably look at this. So South Korea manufactures a lot of semiconductors, right? Um, I'm not sure what I'm looking at here. Um, I don't remember exactly the ticker I wanted to look at. But anyway, I'll find that out later. Sometimes what I would look at would be exports from South Korea, the data from South Korea exports. Also, the Korean won, the currency, versus the dollar. All of this would be indicative of the level of activity that's happening because a lot of the semiconductors, the chips are manufactured in South Korea. So if activity is dwindling there, you should know that typically this is indicative of a GDP slowdown environment. Um, what you could also look is this. So a lot of these companies that are involved in manufacturing of chips, you can take a look and understand what's happening under the hood for them. So this is technically broken, right? When we look at the index, you don't see that level of technical breakdown, but in individual stocks, it's already broken down, right? So if you're looking for short ideas, uh, you can start doing your research within that space, understand what's happening, and then maybe what you do is you wait for a breakdown in this index, you get confirmation, and then you start getting quite aggressive with your trade setup. Is that clear, Bhavan?
Yes, Roshan. Thank you.
I wanted to show you this one as well. This is the US transportation ETF. So this would incorporate trucking, all these freight brokers, couriers, railroads, all of this would be incorporated in this ETF, right? So once again, what are we saying? A technical breakdown, right? Um, a lot of the individual stocks, like if I look at KNX, which is a trucking company, it's already broken down properly, right? So you probably wouldn't go and short it now. It's probably a bit late, and unless you can find that there's more room for downside here. So Kitty is awake, just invited himself onto my desk.
Just when you talk about goods economy, that's a sign, Roshan.
Yeah, I mean, I don't know. Is it a good or bad omen? I don't know. But he's quite funny, right? Like he comes out of nowhere. You don't even know where he's been sleeping, and then in a flash, he's just on your desk and sleeping on your keyboard and wanting to play. But anyway, let's not digress, right? So what I'm showing here is the transportation ETF. If you look at the others, like for instance, this is CH Robinson Worldwide. These are they are predominantly air freight, and I think they are more like a broker. So they are still holding up, right? But the others, the guys who actually operate the trucks and they are more on the ground, they've already started falling. Uh, if I look at this one, this is also another trucking company. So you can see, right? I mean, if you were following these, let's say you go short somewhere here and in the next few weeks, you're already, let's just take a quick look, right? Let's say you went short here and now this whole thing is down 25%. That's a very good trade, right? It's just a question of whether you're you're on the ball or not, right? If I look at KNX, KNX is one I had written a thesis on a few years ago. I don't think I might have shared it in the Discord server at some point. So this is down, let's say, okay, it's down 15%. So uh, probably there's more to go. I don't know. It's at a multi-year support level. So we'll have to firm up the thesis and see whether there's more downside in this stock or not. But by and large, what I'm trying to show you here is there's a lot of pain in these sectors. If you just read the headlines and you're not going deep, you will never be able to understand what's going on. The ETFs, the sector or industry ETFs, are a way for you to shortcut your way to understand what could be happening within these sectors, right? So you could also look at, let's say, railroads is starting to break down now, right? So UNP is one of the largest operators of railroads in the US. They still move a lot of goods by rail, um, and a lot of that happens between uh, Canada and the US too. So with everything that's happening, right, would you expect that there's reduced activity cross-border? Certainly. At the same time, you have economic slowdown. Uh, could this sell off a bit more? Possibly, right? You'd have to do your homework here. Um, I'm sure these are stocks you probably haven't even heard of before. So, doing a bit of this exploratory session helps you to upgrade your knowledge base and widen it and, look far and beyond what you typically look at. Okay? The reason I also look at IYT is because this is a very good reflection of the goods economy. So basically, what is transportation? It's movement of goods, right? Whether it's from export, from imports, right? Getting it from the ships to the warehouse, from the warehouse to the individual retailers, eventually getting this shipped to to the customer, right? This is basically transportation. Um, the same is also applicable for exports, of course. So whenever we're seeing a breakdown or whether this is going up or down, right, it would be indicative of the underlying activity in the economy, especially in the goods economy. There is a very good report. I think Bhavan has been looking into it. It's called the Logistic Management Institute report. So if you want to understand what's happening in the goods economy, that's okay. That's the report to look at. It's similar in nature to the ISM. So they are also a diffusion index. They give a lot of information that's both qualitative and quantitative. So you can read through it. They will tell you what's happening to warehousing, prices, capacity, and so on and so forth, right? Especially now, when there's a lot of talk about whether people have pulled forward demand in anticipation of tariffs and so on. I think this would give you a very good understanding of whether that's happening or not. But when you've gone through the report, right, what are the main headlines that you've seen? Can you share that with us, please?
Yeah, I think I was just going through the summary,
Mm-hmm.
and from that, what I've seen is like there's a lot of movement that has happened late January and early February,
Mm-hmm.
and in late February things has slowed down.
Okay.
So the freight cost and the capacity is coming down. So that probably indicates a demand pullback, which has increased the inventory levels, and then it is coming down because things have slowed down.
Mm-hmm.
And I think one more month of a confirmation, we will probably see that inventory levels are at all-time high and the expectation is also high and the price is coming down. And
Mm-hmm.
that will probably indicate less movement in the economy and sales and more inventory levels. That's what I was trying to gauge at, but I haven't gone through
Right.
it in detail.
Yeah, it's quite a detailed report. It takes a lot of reading through and thinking through to firm up on your views here. So they also give us indication of upstream and downstream. So upstream meaning all the activity that's happening from import exports, and then downstream is downstream to the retailers and consumers. So it's quite an interesting report. I'd encourage you to have a look at that. It gives you a lot of indication in terms of how things are changing. Um, if you look here, right, the biggest changes are happening. So warehousing is getting more expensive. That's quite evident, right? Inventory costs are also getting higher, of course. So when you think about inflation, is there room for inflation to go higher? Of course, right? Warehousing capacity, it's not rising a lot, which means that, warehousing capacity coming down, while at the same time inventory levels going up means that you need to pay higher prices for warehousing. So that's quite an interesting situation. It might be a good idea to start looking at warehouses as a good long. There's one here. Okay, hasn't done. It's basically been stuck in the 40s for like so long. Anyway, but you can do your research. There's quite a few listed warehousing capacities. Um, yeah, you can look at this on your own in your own time. Uh, the one thing that's, glaringly obvious is the warehousing prices, as I've mentioned. Transportation prices are coming down, right? And I think this is predominantly because prices had shot up too high, and now it's maybe correcting in line with, you know, a downturn in economy. So transportation prices would typically be the prices that trucks are able to charge. And if this keeps coming down, I think a lot of these trucking stocks would also come down quite significantly. So you've got all these charts that you can look at. Inventory levels are actually at all-time highs now, right? From 2023. So in the last 2 years, it's at the highest level. So we need to understand whether that's because people are ordering more than usual because of the tariffs, right? And as you increase inventory and warehousing capacity is constrained, inventory costs are also rising a lot, right? So warehousing capacity has been flat or declining, while utilization has probably gone up over the years. So as you can see, this is an interesting report. Yeah, this is. If we look at this chart in its own, right, transportation capacity, it seems to indicate that this is gone lower. So there's been a bit of consolidation in the transportation, mainly in the trucking industry. You probably won't know about it because you don't follow it that closely. So a lot of the smaller companies have gone bankrupt or been acquired by the larger ones. And now I think there's a bit of a consolidation that's happened. And I think there is still more downside for a lot of these stocks because as the goods economy gets weaker, then they will still be scrambling and fighting for prices, which is not great for the stock. But there will come a point where these companies become good longs as well. Now is not the time though. Another bellwether stock for this industry is this one, JBHT. As you can see, technically broken. Another good short. If you were following closely, you would probably, know that you should get short somewhere here. I mean, you can see, right? It hugs this 200-day moving average so much, and then eventually just breaks down lower as it cannot rise above it. So that's the reason why we watch the 200-day moving average. It's very, very important. It gives us a sense of the technical setup. So this stock was probably a short from here, right? Or technically, like fundamentally, you probably would see that it's a short from here onwards. But maybe if you got short somewhere here, the trade would not pay off that well, right? The best spot to get short would probably be somewhere here where, it's kind of a slippery slope and it just keeps going lower. And that's the reason why we use technical analysis for, our timing. It's very important from that perspective. Any questions before I move to another industry? No questions? Okay, I'm just gonna move this here. Right. So what else do we want to look at? I think I wanted to look at this too, the regional banks. So we've seen quite a big sell-off, right, from the highs with the regional banks. And this happened mainly as the credit spread started widening a little bit. There was also a little bit of talk about delinquencies rising and so on. I think this is not yet done. So we should watch for this. So at the moment, it's holding the 200-day moving average. What we should do is probably, just keep a look out for this, start doing our research in individual names. And as it keeps breaking down lower, then we should start getting short. There are a few names that I think I discussed it with Bhavan, but there are a lot of names within this segment that you can look at, and mainly look for companies where they've got loans that are not necessarily of the highest quality, and probably not the best of balance sheets. So banks are a little bit more difficult to analyze. You need to understand what you're looking at. I'm not going to cover it in this session, but anyone who wants to understand how to analyze banks, I think we'll do a bit of a group work session in the Discord server. We've done it a little bit with Bhavan, but I think if more people volunteer, I'd be willing to do it a bit more as a group thing, and then share a little bit of what to look at and how to interpret the numbers. Hans, I think you were also quite keen to do something within the banking sector, right?
Yes, but
Yeah, so we should try to team up on these things. You know, my my way of approaching these things is I always give as much as I can to people who are engaging and actually doing the work and looking at individual companies, asking the right questions, and so on. But the best way to leverage on this would be, if we form a group and we all show equal commitment, um, that would also make me feel like, I do something once and then it's benefiting more than one person, right? It's a bit of a leverage aspect of having the community. So feel free to get involved and to take as much as you can from this. That's the beauty of having the Discord server, right? So going back to what I said, from the first day, you'll only get as much as you want. If you don't want a lot, I'm not going to force you to get a lot, right? So um, this is the KRE. Of course, what you could do as you start your research is go into Koifin and look at the individual components of this ETF and start doing your research from there. I'm going to give you one name that I've been looking at. Uh, this is Zion Spec Corporation. The reason I'm looking at this is because it looks to me that it's technically broken, right? So my whole thesis, maybe I shouldn't say this on a public or what would become a public platform later. My whole thesis on the banking sector is twofold. So actually threefold. Uh, as interest rates come down, they will come down because the GDP is slowing down. So this is not good for banks because as GDP falls, there's a lot less lending activity. So the ability to generate fees from lending goes down. That's number one. As interest rates fall, the term premium would fall, which also puts pressure on the interest margins of banks. So net interest margins are a significant earnings generator for banks. If this gets under pressure, we're currently at all-time highs in terms of net interest margins. So if this corrects a little bit, it would have quite a meaningful impact on earnings and future earnings of the bank. And then thirdly, the angle I'm looking at is increased defaults, whether that's consumer driven or even corporate driven. So as we are seeing, as the economy slows down, cash flows become a lot harder to come by, and a lot more companies would get into financial trouble. We're still very early in that whole cycle. So you've still got a bit of time to do your work on this. Don't take till December though. Maybe give it a month or so. Um, as you can see, the smart money is already exiting these types of situations. So it's not just me who knows about this. There's a lot of people in the institutional world who are already doing their work and trading accordingly. Um, yeah, so what I was saying is as defaults come through, this would significantly impact the earnings of the company. So firstly, they have to increase provision losses for the future. Secondly, the actual losses, what's called the net charge offs, that's the technical term. This directly impacts the earnings of the company, of the banks. So these are the angles from which I'm looking at the banking sector. Um, I think this is a very good play to have, especially if we go into a recession or anything close to that. Any questions here?
Roshan, one question here.
Mhm.
So we have to wait for these indicators to happen, like the interest rates to come down, and then this theme is going to play out, right? But now it's a bit early, and it's the research phase right now. Is
I
that correct?
think you're right. It's look, it's I don't know, right? Because I tend to be maybe a quarter early on things. So sometimes I'll research it and I'll feel like, this is actionable. I should put something in now, and it doesn't work. It only works the next quarter. So as you do the research, I think you will get a very good sense of whether this is something you need to have this month, next quarter. But doing the research is very important because this takes a lot of time. You're not going to just look at one bank. These banking thesis research tend to be industry wide. It also tends to be a bit macro related in terms of what's happening in the US, the economic indicators. So all of that takes a bit of time, right? And at the same time, things would keep evolving. So, for instance, this is one indicator to keep watching: the credit spreads, right? So you'll see this could bounce off and not break down until maybe a couple of months from here. But when it does, everything will just move in one go, right? So the objective is for us to be there when it's happening. We don't know exactly when it would happen. We don't also want to leave it till too late because then the sell-off might be over. So I would say certainly do your research, firm up on a few names, understand how they operate, and Tella, I was discussing this with Bhavan. The banks are not very different from, how we would look at insurance companies, right? What is their distribution channel? Where do they source most of their business? What are the risks associated with that distribution channel? So, as an example, in insurance, maybe uh, they have, let's say, agency forces that are maybe not the best in terms of enforcing underwriting standards. So, if you know this, you would know that in bad times, you should not hold that particular insurance company in your portfolio because by nature, these uh, these books would be a little bit worse of quality than what your best, insurance companies would be. It's the same for banking. And with, what happens, right? When money is cheap and the economy is expanding, credit standards get very loose. And then they start delegating authority to anyone to start, writing loans on their behalf. So they would have third parties that can write loans on their behalf, mortgage brokers, and so on. And even internally, their credit standards loosen. So that's a very good thing to have, or a very good uh, form of information to have on a particular bank or couple of banks, because then you can really pick the losers from the ones that maybe would still be okay even in a sell-off. So as an example, right, if we're looking at regional banks and we think that maybe oil prices would go lower, we could pick one that has a lot of exposure to oil and gas sector. And then as the whole economy is coming down, there's all these factors that I've discussed, but at the same time, the cherry on the cake is the high exposure to oil and gas sector. And then you would see that this particular bank would sell off a lot more than its peers that are a little bit more diversified. So you can see how the research will become a little bit more thorough here, right? So we'll need to firm up a lot on these factors, and it takes a bit of time to get an understanding on all these companies. Um, but yeah, by and large, if a recession happens, this is going to be an amazing trade to work on. Does that answer your question, Tala?
Yes, it does. Thank you. Makes sense.
You know, it's very similar to CarMax, for instance, right? When you put it, you're like, yeah, you know, maybe it's like 1 quarter early or not, and then it actually proves to be 1 quarter early. The trade doesn't work. Then next quarter, you're like, I'm not gonna put it again because it did not work, and then it works amazingly well, right? So this is you know the constant battle of traders, and a lot of times what I say is, uh, you only win if you participate, right? There's no point doing the research, writing theses, and then not having positions, and then the move happens. Uh, you know, you're not, you should not be happy in that situation. You should be very, very annoyed with yourself because you did everything right and you just did not pull the trigger, right? And this is why sometimes I'm like, I don't care if I'm like 1 quarter early, I can factor that into my structuring. So, you know, maybe I put the trade now and then I have a longer time frame. I get exposure on a longer time frame as opposed to just, you know, being there for 4 to 6 weeks. So that's a way to mitigate this, you know, this dance that we're always having in our head as traders. Okay. As we're talking of the banking sector, we can also look at these companies. So Capital One Financial has a lot of subprime exposure in terms of loans. Ali Bank, the largest book of auto loans, and it gives very good information. So I would certainly recommend that you go through their reports and just get a view of, you know, what's happening within the different segments, especially autos. You have this one. I think we've talked about this in like a couple of weeks ago. Synchrony Financial. So when we were talking about this, we were probably somewhere here, and now it looks like it's moving sideways. This might be an opportunity to just firm up on the thesis and then you know, take advantage of these relatively elevated prices, because if we are going short, we think this is probably going much lower, right? Let's say this goes to 40 or 45 region. Um, there's a lot of money to be made if that happens. Okay. I also wanted to speak about this. So when we talk of delinquency, defaults, and so on, there are two types of, let's say, two broad categories of lending activity. One is that happen. One is happening within or by public entities, so banks that are publicly listed, where you can see the stats, you can see delinquency rates, and so on. And then there is also like a shadow form of lending that's happening in the private segment. So there's very little data with regards to the private lending. But what you can be sure of is that whatever is happening in the public is also going to happen in the private, and it could even be far worse because people don't price the risk accordingly because it's not, you know, you don't have regular updated stats on the risks. So the delta that might be there for a stock move in the case of you know, quite adverse delinquency data coming through could be much more than for a public company. There are also a lot of other technical factors here because let's say a company like Blackstone, the moment it starts indicating that there is stress in the private lending market, in which it participates to a large extent, a lot of investors would get spooked and would want their money, right? And you know, as the word is out on the street, everyone would start shorting the stock. You know, the company will start having liquidity issues, a lot of bad news flow around the company, and it would drive the share prices much lower. Most importantly, we care about the fundamentals, right? Eventually, the fundamentals would be proven to be quite weak, and what you'll see is, these types of stock would go much lower. At the moment, when you look at the stock, this is Blackstone, broke below the 200-day moving average, attempted a recovery, got denied. So to me, this is enough evidence that there is a technical breakdown here. I would certainly recommend that you start looking through the information, unless you don't want to make money. That's a different topic altogether. But what I'm sharing with you is, this is literally like we joke about, right? It's front row seat to the whole thing. What you need is basically just the last mile where you do the research, you form your view on this company or something else. Blackstone has many peers, right? So within a couple of hours, you can form your views, and let's say within a day or two, write up a whole thesis and determine your trade structures and so on. And within a couple of months, you could make a significant amount of money. But it just requires you to take action. First of all, just go into their information and look at them and form your view, understand whether there's a setup here or not. I'm not going to give you all the answers. I think I've already kind of brought you far too close to the water, and now it's just for you to decide whether you'll drink it or not. I wanted to also show you this. This is the junk bond ETF. So we've got high yield. We've looked at high yield. Junk bond is similar, but maybe a bit of lower quality. This one shows that it's kind of breaking down technically now. So this whole theme of credit spreads widening, I think this might happen. And if it does, it's not positive for risk assets like equities, right? I'll pause here. Feel free to ask any questions that you might have.
Roshan, would you say junk bonds is like a proxy for private debt, more closer than high yield?
I would look at them together.
Okay.
They kind of it's hard to know, right? It's kind of I would probably say JNK is worse off than HYG, but I would look at them together. Almost like I would say JNK is lower quality. You can establish this by looking at the constituents. It's not very difficult to do that. I don't think this is the right one. Just 1 second. Uh, holdings. Yeah, so you'll have all the loans that form part of, this ETF. Uh, I should probably get. I don't know if they do. Okay, you at least have a sector allocation, right? So 30% of this is in the financial space. It used to be quite highly denominated in oil and gas, but now oil and gas debt is no longer that bad because, they've had a good couple of years. So I actually wanted a chart by credit rating. They don't have it here. Maybe it's on a different website. But these are information you can find quite easily. Any other questions? Um, I'm gonna pick on Hans now. Hans, do you have any questions? Is this kind of giving you is it giving you a sense of direction in terms of, where to find the next few trades?
It is, yeah. And
Because see, the difficulty is that you guys have thousands of stock to look at, right?
yes,
Uh, you need someone or some process or some way of steering you in the right direction to narrow it down to maybe 5, 8 companies, right? And this is basically what I'm trying to do.
yes. I mean, for the banks and loans, it just takes me such a long time, but I think it's all part of a process. Just I'm not used,
Yeah,
I told you, the system, so
yeah,
I
yeah.
have
I
to
think
accept it.
it's also maybe you're looking at things in too much detail, right?
Hmm.
When it's not important. Oh, there we go. We've got a quality breakdown here. So this is the JNK, right? So you've got all these different credit ratings here. So this is the highest, and then this is the lowest. So I think, yeah, none of them are investor. So I think BB and above are investment grade. Um, yeah, I must look at these properly. It's been a long time I've seen this, but you can see the majority is low rated debt, right? You also get a sense of the duration of the debt. So this is important because as interest rates fluctuate, the duration will increase the sensitivity of the ETF. Um, but yeah, this is not something I'm gonna look at in too much detail. But just going back to the bank's hands, it's very important to look at it as a business, right? How does it make its money, right?
Yeah,
How does it uh, how does it make its money? What are its costs? What's happening to all these underlying factors? And eventually, what do you think will happen in the future, right? Banks basically take money from people, depositors, pay them an interest rate on a short-term basis, but then they take that money and then they lend it to other people on a long-term basis, and they collect
yes.
the spread in between the two rates, which is basically called the net interest margin,
Hmm.
right?
Yeah,
And then their profitability is basically dependent on whether people pay back the loans. When they don't, then they have to take it away from that spread that they've collected. So on, let's say, 100 loans, maybe one will default, and then
yes.
that might impact. They might have to take 0.5% from the spread. Uh, they would still be profitable if it's just one loan, but let's say every loan that defaults takes 0.5% from the spread. Let's say the net interest rate margin is 2, right? So they only
Yeah,
have a margin for 4 loans to fail. These are just
yeah,
numbers, for example, sake, right?
yeah, yeah.
So if 5, 6, 10 loans fail, they're in deep trouble. They will make
Yeah.
losses, and then
Hmm.
those losses will have to be compensated from the capital that they keep. So they will burn the capital that they keep as a bank, and basically that's not going to be positive for the equity.
Yeah.
I think it's something that we need to do in a lot more detail, just so people follow and can ask questions. And it's not the most simplest of business models, but also not very difficult to figure out. Okay. Um, what were we talking about before this? We were talking about banks, right? Okay. Is there anything else you'd like me to cover before I move on to something else?
Roshan, when I was looking at Blackstone,
Mm-hmm.
it has a very strong correlation with S&P 500.
Yeah.
So I was just thinking to myself, like, if you're taking a bet on Blackstone, you're essentially taking a bet on S&P 500 to go down.
Um,
Is it
the-
true?
uh, Look, all the stocks are eventually correlated to S&P 500, right? To some extent, they will be because S&P 500 is the average of all the stocks, right? So the reason you pick Blackstone is because if S&P 500 is flat or even going up, Blackstone could go much lower on its own fundamental merits. And if
Hmm.
S&P goes down, Blackstone goes down much more, right? That's the way to think about it. You're picking a company or an asset that has a lot of weakening fundamentals. Um, at the same time, it could be at the receiving end of a market sell-off. So you position yourself for these types of situations where, you know, in 3 or 4 scenarios you win, and then maybe 2 you lose. So that's basically the asymmetry that you're seeking.
Understood. Thank you.
Mm, let's look at the credit spreads now from a different perspective. So you would see that this has gone up a little bit, right? Um, this is the high yield CCC bonds, so the lowest grade. Um, this is starting to tell us that the market is becoming a bit more cautious about credit risk. So let's do an exercise here, right? We've established that in this environment that we're getting into, what are the things that we don't want, right? In other words, what are the things that we are happy to short? What would be the characteristics of these? Anyone? I'm looking for answers like high debt, cyclical, low PE, high PE. What would be the things
Yeah,
that
that's
you?
right. So,
Sorry,
yeah,
Darren.
so we'd be looking at high PE, high debt,
Yeah, high debt. Yeah. What else?
cyclical.
Mm-hmm.
Exposure to credit risk.
Mm-hmm. So either the company itself has a lot of debt, or the company is one that gives lending and has exposure to credit risk from that perspective. Yeah, that's a good one. What else? Give me one last one.
And very thin margins.
Absolutely. That's amazing. So, uh, you've got no idea, right? You're trying to figure out where would be a good place to start. You've just got these criteria that you want to look at, right? So what you could do is you go to Coffin, you go to My Screens, and then you basically start inputting these criteria in your screen. So I'm just going to do something from scratch. Um, let's say I'm not going to put any industry, right? I'm just going to take this away for now. What could we do? Mm, let's have a spin on industry. Otherwise, we'll have too many companies. Um, let's say consumer finance. Yeah. What else? Let's just look for something else. So consumer finance would be companies that give lending to consumers, right? Um, pick one, as you say. Or actually, let's say we have a negative spin on retail, right? Let's do broadline retail, um, specialty retail. And then, okay, just gonna, let's do leisure products too. So anything that's discretionary, that's basically what I'm looking for here. Nothing in luxury. Okay, let's do this as well. And then I want to do retail. Okay, that's it. I don't want any of the others. And I'm looking for market caps, let's say 4 billion and above, right? Just so it's tradable as a short. And then now we start adding some of the criteria that you've discussed. Let's look at margins, right? So net income margin in the last 12 months, let's say we want something that's below 10%, or even let's say below 5%, right? That's very low. We want debt. So, okay, let's do EBIT to, okay, let's do EBIT to, always hard to find these metrics. So EV to net debt. Okay, never mind. I'm just gonna do, actually, you can leave that out and then just add it as a column later, right? So I'm gonna say highly discretionary, high low margin, high debt. So this is the screen I'm playing. Okay. Now I just want to see some of the metrics here. So I'll do EBIT as an expense. Okay. And then is there anything else you'd like to see? Maybe forward PE, price, earnings. Anything else? You maybe want to see debt, right? Net debt. Long term. Net debt to EBITDA minus capex. This is a good metric. Yeah. Okay. So the reason I'm adding these as columns instead of a screener is because now I get everything, right? Otherwise I would have to put a limit, let's say more than 5, less than 5, and you probably miss a few of these companies. So these companies are highly discretionary. They we can sort out by let's say we do, just gonna make this wider. So let's say we sort this out in descending order of EBIT as a percentage of uh, or as a factor of interest expense. So the way to read this is, let's say this company here, Lithia Motors. So they make 3 and then they have to pay 1 in interest expense, right? So that's basically how you read this. So the lower the ratio, the more stressed these guys will become in a downturn. Does that make sense?
Yes, it does.
And then we can refine this and maybe just exclude these by modifying the criteria here. As you can see, of course, this company has a lot of debt, right? Debt to EBITDA minus capex is almost 13 times. So a lot of times you would see companies, they have metrics for financial leverage, and these would look like it typically would be debt to EBITDA or some form of that metric, right? And then they will say that we always try to keep it within the range of 2 to 5 or something like this. These companies might also have covenants with their debt holders, so they cannot exceed these ratios. But what can happen is if the economy worsens significantly, then there might be a situation where they breach their covenants, and then this is quite a serious issue, because the debt holders could call the debt, and then it could trigger a bankruptcy situation. Or, if it just breaks the covenants, or is about to break the covenant, the equity will already sell off in advance of the event actually happening. There will be a significant derating. So if we look at a company like RH, I think this is a very good example to look at. Very low margins, highly indebted. What do these guys do? I think these guys are involved in home improvement, if I'm not mistaken. That's restoration hardware, right? Oh, you can see, right? It's already gotten murdered. So we're a bit late here. So these guys operate as retailer in the home furnishings market. So they've got a lot of debt, a lot of very low margins. The question here is what would make the stock go much lower? It could be something along the lines of material deterioration in the balance sheet. So when we're looking at a company like this as a short, then we really have to establish whether it's already played out. And basically what we're saying is the balance sheet will get weaker, and they might have to do an equity raise, or the debt holders will start creating a lot of noise here, because that's what's needed to get this stock much lower. In this case, I'm not going to go much more in depth with this company. I think this is probably one where you'll need to do a little bit of work and understand what happens from here. So look at this. On the 21st of March, UBS downgraded it from $440 to $250. That's quite something, right? So all of this is very, very recent. The stock has basically nearly halved. So let's put this aside. Let's look at this company, Amir Sports. Very low margins. Oh, something I wanted to discuss, which I didn't. So I know we discussed Nike a few weeks ago. So it had earnings, and then now it's back to the lows, right? So that's setting the mood for retail, for anything apparel, footwear, sports related, right? Um, you would remember, I think it was a discussion between myself and Darren, right? Where we discussed Nike on and on. Uh, and I was looking at this yesterday. So this looks like it's on the brink of a technical breakdown. So earnings have happened recently. It's sold off a lot on earnings. There's still a lot of information to be gleaned here from this and from Nike's report. And I'm sure you should be able to figure out whether this is a short or long by doing your work. Okay? So if you're making notes, add this to your notes. This is an area where I think there could be a lot of alpha. Let's go back to this one. So this Amir Sports, I quite like it. It's 16 billion. So as a short, there's a lot of potential here. So if we look at the historical chart, basically what's happened is revenue is coming down, but EPS is keeping up. So this is a typical retail company. So we should be able to analyze it fairly easily. Earnings are still projected to grow quite a bit, which is quite interesting. Revenue is expected to grow quite a bit. It's getting upgraded as well by the analysts, which is another interesting fact. So we need to do a bit of digging to see what's actually happening with this company. why does it have such low margins? Is it possible that it can increase its margins? The environment is quite difficult. So while Nike and all the larger incumbents are actually, at the receiving end of the economic cycle, can this company maintain pricing and grow margins from here? That's the question we need to ask ourselves. So they sell predominantly sports equipment. So it's like a Sports Direct in the UK. Yeah, golf and all of these things. So this should be a good one to study from a shorts perspective. It's got a relatively high forward PE. So the market still likes this company very clearly. We just need to establish whether these estimates are valid or whether there is a possibility for these to come down quite significantly. Especially the reason I mention this is when we look at these rates of growth, that's quite significant, especially in a consumer sentiment, falling environment. Let's go back to the level of debt here. So, okay, not a lot of debt. Okay, it's interesting. So that's one to put on your watch list or free watch list for you to do a bit of research. Um, and then basically you can go through the rest of the list and figure out, whether there's a good opportunity to be short or not. For instance, this company here, CPNG. Yeah, so it operates retail business in South Korea and internationally. So I think this is another company we could look into. Definitely doesn't look like a short as you see here, but whenever you've got thin margins, one needs to be very careful that just a small change in the revenue would cause things to get really tricky for the company. So they've got okay, so they've been improving their net income margin, but it's still very, very low, right? I mean, this is terrible. You make 8 billion in revenue and then it's like 156 million as profits. It's a very low number. Of course, we have to dig into it and understand why. They might be reinvesting in their business and so on. So they make 8 billion revenue, then 5.5 billion is basically cost of goods sold. 2 billion is selling expenses. So basically marketing, paying people, staff members, and so on. And literally they end up with 354 million from 8 billion of revenue. Eventually they actually make 13 million in terms of net interest. That's interesting. So they're getting revenue on their cash balances. But eventually net income is only 156. So after paying taxes and so on. So these are the types of companies where, if the market slows down and revenue comes down, they will have a lot of difficulty. Let's do this exercise now for another sector or industry. Are you guys following? Are you getting a sense of how you can find some of these companies with these matching criteria? Is this helpful?
Yes, that's very helpful. And it's funny to see Karl Marx on the list.
Is it there?
Yeah.
Oh, yeah, of course. But this is quite misleading though, because a lot of the debt is auto loans. So it's not debt that the company has taken.
Okay, yes.
Oh, I think that's how you should interpret it. Okay, we could look at we could go back to consumer finance and just do, okay, just gonna do none consumer finance. Another area I was thinking is these professional services. I think there's a bit of downside potential here, but for our purposes, let's look at this for now. I'm just gonna do lend capital markets, maybe financial services. Yeah, that should do. Banks are going to be a bit different though, because they would typically show much higher levels of debt, cash flows, and so on. This is not what I was expecting. There's something wrong here. Ah, because I've shown low margins. So if I increase this to 10, hmm, okay. Yeah, so you would need different ways to look at this. Um, Look at this net income margin. This is crazy. You've got, of course, you've got Affirm and Upstart. Okay, so criteria is not right here. So maybe what I should do is take away this, because we're not necessarily, for banks, we don't need net income margin to be low. So now we have a much higher number of companies. What we also want for banks is, so I'm sharing all the shortcuts here. So this is the price to book ratio. So basically, this is the value that the market is putting on the books of the company. So let's say you've given out 10 billion of loans, but the market is probably just valuing your loans at 9 billion, right? Because they perceive that there's going to be higher risk of delinquency. So that would get reflected in the price to book ratio. Is that clear?
Yes, just to clarify in the example that you
Mhm.
gave, so the price to book ratio would be 0.9, right?
That's right. Yeah. So the higher the price to book ratio, the more premium, let's say, let's put it this way, the more premium the market is kind of assigning to that company. Yeah. The problem with banks is that you cannot value their loans that easily, right? This is within the bank and you don't have access to all the data. And the market will trade the equity accordingly to put a value on the loan asset. If you take out a loan, it's a liability for you, but it's an asset for the bank, right? Because you're paying money to the bank is getting money, so it's an asset for them. Does that make sense?
Yes, it does.
So remember this every time you go and sign for a loan. Remember this. There's a big value transfer that's happening. Okay. Right. So these companies with low price to book ratios should be a bit of a red flag for us. So if we start digging, we should start digging within these companies. Yeah. Of course, if you look at this, it's likely to have already sold off a lot because the market is basically saying you're valuing your loans at 100, but we don't believe you. We value it at 70. Okay. So As expected, there's already like a short murder that's already happened here. What does this company do? It basically provides banking products and services. So, it's a bank at the end of the day, maybe operating as a mobile app or something like that. So, yeah, it's actually a bank. It just doesn't call itself a bank. Yeah. So as you can see, this is literally shortcutting your way to a few companies that you can look into right away and figure out what's happening. A lot of these are regional banks. So, for example, Citizens Financial Group is a regional bank. This one too. TFC is a regional bank. We've got our beloved Ali. Um, yeah. So, yeah, if I was looking at this from a short perspective, I'd probably look at these ones. So anything between 0.8 and 1.1, 1.2. Um, I wouldn't want to look at the lowest because the market has probably already factored a lot of stress in these companies. So I would start off looking at maybe these four here, and then forming a view on what's happening, and then determining whether there's an idea there or whether you want to look further down the list. So what I'm showing to you is, a little bit of process in terms of how you can shortcut your way to finding these companies. Of course, you can go the traditional route where you just look through banks and then you look at everyone and you basically pick a few and then you start doing your work. Uh, there are different routes to the same destination. Does that make sense?
Yes, it does.
Yes.
Okay, so I think I'll probably end here. I'll open up for any questions that you might have. We've got roughly 10 minutes to go. Feel free to ask your burning questions. It could be about anything we've discussed today or anything market related.
It's not a question, just something I it's like a forward P for banks are really low compared to what we are used
Uh, yeah,
for
because
these at least.
you're looking at the worst ones here, right?
Yes, yeah,
So
but
if you were to look at this, it does get into the high 30s and so on.
mhm,
But banks tend to be a bit lower because they are cyclical also in nature, right?
mhm.
So that's already factored into it. These ones are high because they are like tech lending solutions and all of this. It's not typically a bank. It's basically like a payment, not a it's kind of bundled with payment processing, right? Instead of you paying one off, you do these
These
buy
kind
now, pay
of
later stories
yeah,
like
these very
Klarna.
popular credit
Yeah, yeah,
things that's available here.
yeah, 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 yeah.
Okay.
So, any questions in terms of what to do in the markets in the next few weeks?
Hey, Roshan. Yeah, so one thing
Good
that I've
day.
been thinking about and wanted to explore more was,
Mm-hmm.
companies that are currently making losses and that
Mm-hmm.
the market was expecting growth in the future in terms of forward PE. I think if we could add views, like in our like filter as well, I think these could be facing a lot more difficulties and pain. Um,
Um, okay, so you're looking at companies that would have already sold off a lot, and you think it's just gonna go much lower, right?
That's right. That's right. Those that are making losses, and then the
Mm-hmm.
market is expecting kind of a growth, and sometimes we might not um sell off as well because we still hope that they're gonna grow into that forward PE valuation. You see what I mean?
Um,
Um,
yeah, I mean, look, there's two aspects here, right? Forward P can go high in the case of a small company that's expected to expand and grow into its PE, right? That's one. The forward PE can also go much higher when the earnings basically go to shit. Then the price stops coming down in anticipation that this is a cyclical company and it would actually start recovering. So let's say price is $10, earnings is 0.1, then forward PE is 100, right? So you have to understand what situation you're looking at. Uh, what is certainly a good theme, and it's probably been working great, is all these high PE companies where people were expecting a lot of growth, but GDP is slowing down. Of course, then expectations have to come down. We're talking Wingstop, Kava, all these companies. And as the results come through and they're not able to grow as quickly as they were expected, then the market
Okay.
will have to factor that in. And there's a lot of room for them to move because, they trade at 60, 80 times PE. So going from 80 to 40, that's 50% drop, which is amazing
Yeah,
for
that's right.
us.
And I think we can make really big on that,
Yeah.
based on
Yeah.
like, the
Yeah. I
expected
mean,
price action.
if you look at Kava, for instance, um, look at this. Start of February, this was trading at 140. Now it's 83. Could you make money here? Of course. Do you need to be at a hedge fund? Do you need to be like, I don't know, like a genius to make money in this stock? Probably not. Right. It takes a bit of understanding of why it was trading at 140, right? And what would happen in the next few weeks as the market regime is changing. I'm pretty sure we were doing webinars around here, right? Every week we've been doing webinar from, you know, start of Jan, actually from start of Feb, right? Start of Feb onwards. So you knew the market regime was changing and you knew that this was pricing in a totally impossible like set of expectations. And then on earnings day, it actually gets validated and it just sells off further. This is an easy trade, right? 140, maybe you put it here at 130 with a break-even price of 120, and then you probably exit the trade at 100 or something. You easily make 500%. It sounds very simple when you know exactly what's what the market has priced in behind the scenes, and you know that there is a regime change happening. If you don't, then you would always be staring at these stocks and not being able to pull the trigger. So, from my perspective, there are so many easy wins in this market, and people are just focused on things that don't matter. That's my view. What do you care about the S&P QQQ if you go from 130 to 100 or 80 in the stock here? What relevance did the S&P QQQ or anything else have, right? Put call ratio or whatever, option gamma expiry. How does that factor into, you know, this is pure fundamental trading, right? You see where I'm going with this, right? There's a lot more money to be made predicting this, whether this goes up or down, versus reading all, which is of zero value.
And now, what are the things that you look forward into this week?
Sorry, I didn't get that.
Yeah, so what are the indicators that you're currently looking for this coming week to validate more, like, what you've seen so far?
Um, I think you missed the first half of the session, right?
Yeah, I had to drop for a bit.
Okay, so
But
Maybe
Yeah, maybe I
watch
can
the
rewatch it. Yeah.
watch the recording again because
Mhm.
we basically spoke about basically why do I think the market hasn't bottomed yet. So I show different components of what forms my view. And these are basically the things that I'm watching. Nothing significant, it's not like I have some proprietary thing that I'm looking at. I'm basically trying to make sense of everything as the market is trading. So, yeah, I mean, this is one example of what I'm showing you guys, Kava. You've also got Wingstop. So you also had Shaq, as you've discussed quite a bit, Darren. That's also been another like bread and butter trade, right? So the market offers all of these guys. It's for you to find them. Let's do what AutoNation. Let's see what AutoNation is doing. Okay, so this guy's probably going to be stuck around here now, right? Until it breaks lower. So who says that AutoNation goes to 140? Who thinks this can go to 140?
I think so in this environment,
Hmm.
but we'll have to work to
Yeah,
make
it's
sure
it's
that
not a stock that moves a lot, right?
no.
It's very timid, and then when it moves a lot. Yeah.
Mhm.
So it's very range bound. And look, I mean, this is pure technical chatter now, right? So this is called a head and shoulders formation. So this is the shoulder, this is the head. Uh, I hope we don't get the shoulder here and that we go straight to, to typically in technical analysis, they say the distance that this can move when it breaks below this is equal to this. This is called the neckline, right? So if we do some rudimentary technical analysis, uh, actually, yeah. So this is 41 points, right? So if I were to do 41 points here, yeah, let's do it here, right? So this typically could go back to, let's say, 115, right? Um, of course, it's not going to go there in one go, but yeah, maybe this is probably what we're looking at. By second half of the year, this could be 130, 1500, somewhere around here. That's what the technical analysts say. I'm looking at it from a fundamental perspective. So it tried to form this head and shoulder pattern here too, but then it never broke below the neckline, and then it kept rallying higher. So, guys, has this session been helpful?
It's been very helpful. Yeah.
Yes, absolutely.
I also need to understand is this like too high level or too complicated? How do you feel about it? Is this pushing you closer to getting your idea, or is this too far remote?
I think it's good. It's really pushing us, and I think everything that you explained was within reach, to be fair.
Exactly, exactly. This is it's not rocket science, right? You basically just need to know what you're looking at and how everything is forming the picture together. Once you do that, then it's not very difficult. So just to before I end, because I have to go now in 2 minutes. So for alternation, what I did was I basically sold a call option at 155. So when the market got quite low, 255 or something. I think it got to 156 or something. I sold a call option, which expired on Friday, right? And now basically I've got naked, sorry, not call option, puts, a put option. And now basically I've got naked put options to expire into April. So that's basically how I use the volatility in the stock. And now, hopefully next week we get a bit of a move down. I probably would look to take profits if things move in my way over the next 1 or 2 weeks. So a trade that was looking quite bleak in terms of outlook, and then suddenly it works.